You open your credit card app and your balance says $412. Then you check your credit report and it says you owe $3,218. So naturally you're thinking, where did that balance come from? Did the credit bureau make a mistake? Did your bank report the wrong number? Not necessarily. Your credit card can report a completely different balance from the number you see in your banking app today. And if you don't understand why, you could pay your card in full every month and still wonder why your credit utilization looks high or why your credit score suddenly dropped. So in this video, I'm going to show you which balance usually gets reported, when it gets reported, why your due date is not the only date that matters, and how to manage your card without carrying unnecessary debt. Let's start with the biggest misunderstanding. Your credit card basically has multiple numbers you need to understand. Your current balance, your statement balance, and your minimum payment. These are not the same thing. Your current balance is basically what you owe on the card right now, based on transactions and payments that have posted. So maybe today you open your app and see $412. That number can change every time you use the card or make a payment. But your statement balance is different. At the end of your billing cycle, your card issuer creates a statement. Imagine that when your statement closed, your balance was $3,218. That $3,218 becomes your statement balance. Then, 2 weeks later, maybe you pay most of it off. Now your app shows only $412. But your credit report could still be showing that old $3,218 balance. Why? Because credit card companies generally update the credit bureaus periodically, usually around once a month. And the balance reported is often connected to the balance around the end of your billing cycle. Reporting practices can vary by issuer. And this is where people get confused. They think, I already paid that. You probably did. But your credit report is not necessarily showing your balance in real time. Think of it like somebody taking a picture. Your banking app is showing you what is happening right now. Your credit report may be showing you a picture your lender sent earlier. That picture can stay there until the lender sends another update. And that matters because your reported credit card balance can affect your credit utilization. Let's make this extremely simple. Imagine your credit limit is $5,000. Your statement closes while you owe $4,000. That means the reported balance could show roughly $4,000 against the $5,000 limit. That is 80% utilization. Now imagine you pay the entire $4,000 a few days later. Your actual balance may now be zero. You did not miss your payment. You may not owe interest if you paid the applicable statement balance in full according to your card terms. But your credit report may continue showing the previously reported $4,000 until the issuer sends its next update. FICO specifically explains that paying a balance after it has already been reported does not instantly change the previously reported balance. And if a credit score is calculated using that report before the next update, it can still see that high utilization. That is the hidden part. Paying your credit card and reporting your credit card are not exactly the same event. Now let's talk about another mistake, the due date. Most people know their payment due date, and they should, because paying on time is extremely important. But there is another date you should understand, your statement closing date. Your due date tells you when your required payment is due. Your statement closing date marks the end of that billing cycle and determines the transactions included on that statement. Those two dates serve different purposes, and your card issuer may report account information to the credit bureaus around the end of the billing cycle. So imagine this, credit limit $10,000. You spend $6,000. Your statement closes with that $6,000 balance. Then you pay $6,000 before the payment due date. From a payment perspective, great, but if the issuer already reported the $6,000 statement balance, your report can temporarily show $6,000 being used out of your $10,000 limit. That's 60% utilization. This is why somebody can say, but I pay my cards in full every month, and still have a meaningful balance showing on their credit report. The CFPB specifically notes that credit scoring considers how much credit you are using compared with how much credit you have available. Now, does that mean you should become obsessed with your statement closing date every month? No. And I definitely don't want you missing your actual due date because you're trying to play some credit score game. Your number one rule should still be never miss your required payment. But if you are trying to control the balance that appears on your credit reports, especially before applying for something important, understanding your issuer's reporting schedule can be useful. For example, instead of waiting until your due date to pay down a very large balance, you may choose to make a payment earlier. So if you have a $10,000 credit limit and you've spent $7,000, you might pay $6,500 down before the balance is reported. Now only $500 may remain when that reporting snapshot is taken, assuming your issuer reports at that time. Instead of potentially showing $7,000 out of $10,000, your report might show something much lower. But here's an important warning. Different issuers can report at different times, so don't assume every credit card company works exactly the same way. Experian notes that issuers generally update monthly and often around the end of the billing cycle, but the exact timing can vary. If you really care about the timing, check your statements, monitor when your report normally updates, or ask your card issuer when it typically furnishes account information. Now let me clear up another credit myth. You do not need to carry credit card debt and pay interest just to build credit. I still hear people say, leave a balance on your card so the credit bureaus know you're using it. That does not mean you need to carry debt from month to month and pay interest. FICO explicitly says carrying a balance and paying interest is not necessary to build a good FICO score. Those are two completely different ideas. A balance can appear on your credit report because the card was used during the billing cycle. You can then pay your statement balance according to the card terms without intentionally carrying expensive revolving debt. You do not get bonus points for giving the bank interest unnecessarily. Now let's go back to our thumbnail example. Current balance, $412. Reported balance, $3,118. At first, that looks crazy, but now you understand what may have happened. Your statement closed when your balance was $3,018. Your issuer reported that balance. Then you made a payment. Maybe you spent something else afterward. And now your current balance is only $412. Your banking app changed immediately as transactions and payments posted. Your credit report did not necessarily update at the same time. So the $3,218 isn't automatically an error. It may simply be older information waiting for the next normal update. And this is exactly why I don't want you checking a credit score and panicking every time it moves. Before you panic, look at what changed on the report. Maybe your reported card balance increased. Maybe another card updated. Maybe a payment has not been reflected yet. Maybe the score is being calculated from a different snapshot of your credit information. Look underneath the score. Now, if the reported balance stays wrong even after your lender has updated the account, that becomes a different situation. For example, suppose your lender reports that your account was paid down, but your credit report continues showing information you believe is inaccurate. You can review the account details and, if the information is genuinely incorrect, dispute the error. But don't dispute a legitimate statement balance simply because it looks different from today's balance. The timing may explain the difference. Now let's talk about utilization itself. Your utilization is basically reported revolving balance divided by available revolving credit. So if you have a $1,000 limit and $900 gets reported, that's 90%. If $300 gets reported, that's 30%. If $50 gets reported, that's 5%. Generally, lower revolving utilization is better for FICO scoring, although the exact score impact depends on the rest of your credit profile. And there is no magical cliff where 29% is automatically amazing and 30% suddenly ruins your credit. Think of utilization more like a risk signal. The closer your cards look to being maxed out, the more risk a scoring system may see. That is why somebody can have 0 late payments, 10 years of credit history, and still see their score move when a large balance gets reported. Maybe they normally report $500. Then one month they buy a laptop, book a vacation, or pay a large business expense, and suddenly $7,000 reports. Nothing necessarily went wrong. The credit profile just changed, and the score reacted to the information available at that moment. Now here's how I would handle this without making credit cards complicated. Number 1, know your payment due date. Never miss it. That is non-negotiable. Number 2, find your statement closing date. Open your latest statement. You should be able to see the billing period and statement information there. Number 3, watch the balance that appears on your credit report. Compare it with your previous statement. You may start noticing the pattern. Number 4, if you are regularly using a large percentage of your credit limit, consider making payments during the billing cycle if your cash flow allows. You do not have to wait until the last possible day to pay. Number 5, do not spend money just to create utilization, and do not carry expensive debt just because you think it helps your credit. Number 6, if you're preparing for an important credit application, understanding when your balances report can become more important. Maybe you're about to apply for a mortgage, an auto loan, a new apartment, or another credit product. You may not want a temporary, unusually high card balance showing if you have the money available to pay it down first. But again, no trick guarantees an approval or a specific credit score inquiries. Lenders consider much more than one balance, and scoring results depend on the entire credit profile. Now, there's one last thing I want you to understand. Credit utilization can make credit scores feel confusing because it can change from month to month. One month your reported balances are low, another month they are high, your score changes. Then the balances update again, your score can change again. So don't treat every movement like a financial emergency. Focus on the bigger habits. Spend within your means. Pay on time. Avoid unnecessary interest. Keep revolving debt under control. And understand what your lender is actually reporting. Because once you understand the difference between current balance, statement balance, payment due date, and reported balance, credit cards become much easier to understand. So the next time you open your credit report and see a balance that looks completely wrong, don't immediately panic. Look at your last statement. Check when the account last updated, because that balance may not be showing what you owe right now. It may simply be showing what your lender reported at its last update. And that difference could explain why your credit utilization and potentially your score looks completely different from what you expected. Your current balance is what you see today. Your reported balance may be a snapshot from earlier. Know the difference. Because your credit score can only react to the information that has actually been reported. If you want more videos breaking down the credit rules banks and credit bureaus don't make easy to understand, subscribe to the channel.